Okay, so I'm recording the meeting now. Okay, so let's do the bear attack. I'm going to switch over to the chart and take a look at what's going on right now in the big picture market view of the S&P. And I'm going to change the share. Okay. What you're looking at right now is a monthly chart of the S&P 500. And I'll show you, this dates back to, this was that 2007 to 2008 decline. And what we have are two lines on an 8-period moving average and 21-period moving average. The 8 and 21 is something myself and Becky learned from way back when we first started trading. It was from John Carter at Hubert Centers, trademarkets.com. And we've always gone over the 821. It's if you look at my computer at all my charts, and whenever I'm looking at something, I'm always on an 8 and 21 period moving average on my charts, because it gives me a general indication of bullish or bearish trend. So I make some other decisions based on that. The last time we had this is a monthly chart, okay? Generally speaking, once we cross above the orange line is the 8-period moving average. Once we cross above, so the 8-period move crosses above the 21 period, which is the blue. And the orange line is the 8-period moving average. We got a bullish cross. This happened back in 2010. And we haven't crossed down since, okay? Once we had this bullish cross, the 8 stays above the 21, and most of the time the price will stay above the 8. This is a monthly chart. Every couple of years, the market will pull back to the 8, and it'll pull back to the 21, close back above, keep going. Pull down below, close back above, kept going. This was 2018, closed below once, closed right back above the next month. This was when the pandemics shut everything down in 2020. Pulled back for like 1 month, then right back above, and the long-term trend keeps going on. Right now, where we are again, pulled back, came closer to 21, right? We're still in that big long-term bullish trend. Nothing's changed. Usually what happens that freaks people out, number one, media freaks people out. They'll see a down day and they'll tell you the sky's falling. So everyone's going to lose their money. Everyone's 401k is going to go to hell, basically. And it's like, but that's what they do. And then the next day is an up day, and then they, well, never mind what happened yesterday. So don't get freaked out looking at the news. We're in a massive uptrend, and periodically markets pull back to major support and life goes on. If we were to see 2 significant closes, consecutive closes below this level, then we'd probably be dropping down a bit. But right now, we're just still in this massive uptrend. It's just that it might take 3 months for the market to go up a certain amount, but it might only take 3 or 4 days for it to come back down that same amount. So it just freaks people out. So don't get all stressed out over a bearish market move. What it does for us is give us an opportunity to make more money faster because the markets are moving faster. That's all it does for us. All right. There's a handout. Take a look. Let's see. The handout, there's a link in the is in the chat window to get the handouts. So if anyone just go to the chat window and there's a link there, and you can download a PDF of the handout plus some other videos and other spreadsheets. All right. So that's all it is. Nothing major. There's no big change in the world as far as our trading and the markets go. It's just periodic pullbacks.
Can I ask a quick question on that?
Say that again.
Can I ask a quick question?
Yeah.
Yeah. Just going back for the last 12 years, of the Federal Reserve been printing so much money, especially in the last few years, 120 billion a month, keeping them rates at 0.
Okay.
And now they're actually going to be doing 0 of purchasing any treasuries or anything. They're actually going to be raising rates. Do you take that into account?
No, because we have no control over day-to-day, minute-to-minute, anything. We're not economists, and economists don't give you buy signals. Economists don't give you sell signals. any and everything that the Federal Reserve does or any other organization on the planet in every other country that affects interest rates anywhere, not just the US, anything they do will be reflected in the daily, weekly, or monthly or annual open, high, low, and closing price. Done. And it doesn't change. Anything it does will be reflected in the charts with the open, high, low, and close.
Right, but that's what I mean, because
Yeah.
they're already pulling back. That's why the Nasdaq's down 15%.
Yeah, and there are things happening on every month of every year. There are Federal Reserve changes. There is wars in the world. There is turmoil someplace. Oil is doing this. That's all through every single month of every single year, every single day. It's all built into the charts, and it all creates the patterns, which repeat and repeat and repeat. It's all built in. That's what creates the charts. Because so what one economic report does is irrelevant. It's only relevant if you might be a day trader and you want to see what a report does in 1 minute of the day. But we don't day trade. Whatever anyone says in one country during 1 minute will impact something for that minute. We're not listening to what other people are saying in every other part of the world that affects all the markets, that affects all the currencies. Everything's tied together, but it all creates one open, one high, one low, and one close. That's it. So we don't try to speculate. We don't do a what if. We don't do a looks like, feels like. So everything we do is 100% objective. If this, and this happens, we expect the market to move in this direction, a certain magnitude within a given amount of time. So that's how we trade. We don't speculate at all. So I'm going to switch over to the daily charts for the futures and then take a look at that, because everything we do is statistics based and historical based on his history. And history also has to include reality. So I'll talk about that also. I'm going to change the share to the daily chart. All right, so now I'm back to a daily chart of, and let's take a look at, today we're going to be looking at futures. So let's take a look at, I'm going to do the Aussie just because it's a dollar a point. It just makes the calculations easy. All right, so this is a chart of the Australian dollar future, and we're gonna, so this is the Aussie. And since it's futures, I'm gonna switch over just to give you what's the numbers that are involved. You share, so we can look at dollars and cents and know exactly what we're looking at. Futures, share. All right. This is my Street Smart Central account on Schwab. Currency futures. So if I take a look at currency futures, I'm trading the Australian dollar. If you have a bigger account, you can trade the full size contract, where one tick is equal to we usually go with the 4 decimal places. So 0.0001 being $10. So if we go 5 decimal places, you can do a half a tick, 5, but 0.0001 is $10 a tick. We're looking at the micro futures, where 0.0001, every increment is $1 per tick. It's 1/10 the size of the full size contract. The margin is 1/10. So it gives everyone the ability to trade the futures without having to have a massive size account. So if you have like a 20, 25 grand account, you can trade the currency futures and index futures with the micro contracts very comfortably, okay? Risking between $500 and $800 per trade in that neighborhood, and be able to trade it fairly comfortably without worrying about taking big risk, because the risk should be the same on every trade. All right. So how many Does anyone have zero knowledge of futures? Zero knowledge. You can, and feel free to unmute or just type in the chat box. Who has zero knowledge of futures?
I do.
Okay, so you know, we're not going to be talking fundamentals and background of futures. This is purely technical trading. So all we care about is numbers. If so all we need to know for the futures is the chart, what each tick is worth, and how much margin it occupies. It doesn't matter what we're trading. We just have to know, because you go to different futures products, it increments in different amounts. It increments in ticks. So each tick is worth different amounts. One tick in the S&P is different, has a different financial value than one tick in the NASDAQ, is different than one tick in the Dow, is different than one tick in Euro, is different than one tick in the British pound. So as long as we know what each tick is worth dollar-wise, all the charts work the same way, okay? Charts all work the same way. We just need to know what each tick is worth. All the calculations are the same. So it doesn't matter what we trade, as long as we understand the technical analysis, because everything we do is technical analysis. If you want to learn more fundamentals behind what each thing is, that you can go and research on your own, but it's used, but for ours, that's going to be for your own personal knowledge. But for our trading purposes, it's just additional information, but not a factor in any way, shape, or form with any decisions we make about our trades in any way, shape, or form. If an economic rate announcement is coming out on the Aussie or the Euro or FOMC is coming out, is going to affect all the major markets, none of that information has any impact in any way, shape, or form in any of our decisions in trading, because that is just pure speculation of stuff we make up in our own heads, unilaterally decide, make decisions in our own head, something is right or not, and then put money on it. We don't do that. If I can't show you that something is going to historically repeats 80-something% of the time, and then I would never show it to you because I wouldn't be trading it. If I can show 100 people one strategy and show them what the outcome would be if we all traded that strategy, and all those 100 people don't all come to the same conclusion, then I'm doing something wrong, okay? Because I don't trade like that. Anything I do has to be repeatable, verifiable, and someone else has to be able to look at it and come to the exact same conclusion. And that's purely math and statistics, okay? And we'll be going through some of the numbers for the last couple of years to give you an idea of what to expect from returns, monthly and annual returns, if you're trading the strategies in a dedicated and business-like manner. It'll give you a good feel for the kind of returns to expect, all right? So everyone who has a futures account should have somewhere on their brokerage platform where you can get this information for each of the different contracts. Go over here, you got margin requirements. And this is a big important thing, how much margin you put up. Let's take a look at the S&P, for example. If I'm trading the full-size contract, I have to put up $15,000 for every one contract I open, okay? That's just to open the contract. I need to have 15 grand. If I'm trading 3 contracts, then I need to have $45,000 in my account just to open 3 contracts. Now, if I'm trading the micro, that's the MES, it's basically 1/10 the size. So instead of $50 a point for the full-size contract, the micro is 1/10 or $5 a point, okay? And so, and the margin is only $1,500 for the to open the contract, or $1,600. All right, so by having the micro contracts, it gives us all the ability to trade regardless of how big an account we have. The people who have an account with hundreds of thousands of dollars or more, you can trade bigger size, you can trade the full-size contracts, or you trade more of the smaller contracts. It all depends on what you're doing and what risk levels you're accepting and your strategy. But there's something here for people who have big accounts and for people who have smaller accounts. If you have really small accounts, then you trade the currencies because you only need a couple $100 just to open one contract with a margin. Okay, so one of the big benefits of the futures over options is you don't have all the variables that options have. Options have time decay. The price goes up with volatility. You might have a perfect trade set up, but you can't buy the option you want to buy because it's just too expensive. That's not the way it is with futures. Everything is very exact. And from just between our option strategies and our future strategies, the futures are literally 2 to 3 times as profitable at our first profit target as the option trades are at the first profit target. And that's because we don't have time decay and the volatility issues. Okay, so I'm going to switch back to the charts. You guys ask me any questions you want along the way, and I'll do my best to answer you. But I want to show you the approach for this bearish trade setup. And this is one we did on Forex. So if you did Forex with me, it's the bear attack. All right. We haven't done it in a while because I haven't been doing Forex in a couple of years. I switched over back to futures. So I'm doing all futures now. Plus I'm doing options on oil and the metals. So my focus is probably 80% futures, 20% options. And that works really, really well for me. Remember, just because you know how to trade something doesn't mean you're going to be trading everything. You put your money where it's being best utilized. And with me, since this is really my only real income, since COVID shut everything down, my money is best utilized in futures because I get the best returns. All right, so I'm going to switch back to the chart. All right, so I just chose Aussie dollar for this example today because it's $1 per tick, as it just makes the calculations a lot easier. I'm going to go through one trade example, put some numbers to it, and then take a look at a big picture for the trades over the last couple of years to show you how it fits into the big picture. All right, the blue lines and the purple lines, trigger lines, linear regression line and the moving average of the linear regression line. The linear regression line is available on most trading platforms. The moving average of it is something that's not readily available. You have to program that yourself. If you're working with me as a coaching client, then I will provide all of the charts for you already set up, everything ready to go. You don't have to recreate stuff from scratch. I'll have everything for you, and you are set, ready to do your analysis. The platform we're using is NinjaTrader. It's free to use for everyone. You don't have to pay for it. NinjaTrader is free. You only pay for NinjaTrader if you're going to use it for actually day trading a live account with a brokerage. Then you have to pay for it. But since we just use it for analysis, it's free to us. Okay, you're going to be day trading through it, because you can program NinjaTrader to automatically trade for you. That's what we used it for initially, way back when we were day traders. We would just program the software up and it would trade, place our trades, manage it for us, get us in, get us out. We just sit there and listen to the cash register ring, which is what Becky really, really liked. Is hit a cash register ring, it moved the stops for us automatically. But since we stopped day trading, we just use it now for analysis, and it works really, really well because you can do analysis on a platform that you can't really do on other platforms because the indicators and stuff is just not readily available. So, and you can pretty much program up anything on here that you want to, if you have the knowledge or you have the resources to find someone to do it for you. So it's a really nice platform that's free to use, and you can do a lot with it. So let's take a look at this now. Trigger lines. When you see it blue, it's in a bullish crossover. When it's purple, it's a bearish cross. In a bullish cross, this top line is plot 1. You're going to see the same value showing up in the data box, and everything is color-wise matches the chart. So plot 1 and bottom line is plot 2. When plot 1 crosses below plot 2, the color changes. It's now bearish. Now this is plot one. So plot one is this moving average, and it crosses below plot two, and now it's bearish. Okay, so that's the trigger lines. It's a linear regression line and a moving average of the linear regression line. All right, and we have different strategies. We have different settings for different strategies, but you're going to see the trigger lines on many of our trading strategies and charts, whether it's options or futures or stocks or ETFs. You'll find the trigger lines on there with some different setting. All right. Any questions so far? And ask anything, even if you think it's a silly question, feel free to ask it and we'll talk about it. Because if you have the question, someone else might also. You can either type in a chat window or just unmute and ask a question. Let's check in to see who's here. All right. So let's take this example. It was on November 2nd, 2021. And we got a bearish cross. Here's what we look for each day. If we were doing our day-to-day analysis, it takes literally seconds to go through a couple of charts. We trade the Australian dollar this is a trade specifically for currencies. So we trade 5 currencies. We trade the Australian dollar, British pound, Canadian dollar, euro, and Swiss franc. So let's say today was October 28th. This is what our chart looks like. No bearish cross. It took me a second to see that. Next chart, next chart, next chart. Okay, the next day, no bearish cross, nothing to do with that strategy. Next day, no bearish cross, nothing to do. Hey, we got a bearish cross. Okay. So once I see this bearish cross, we're not going into detail to confirm it, but bottom line, it has to be a bearish cross and this candle has to be red. There's an indicator on this chart called the super trend, and it will color the candles red or green, regardless of if it's an up day or down day. It just gives it a directional bias. Okay, so these are up days, down days, but they're all green. Doesn't matter if the candle is filled in, it's a down day. If the candle is empty, is open, it's an up day. So this is a filled in candle and it's red, it's colored red. It's a down day and it turned red. So if you take a look at the sample plan that's in the handout, it says on the signal data, the bearish cross on the trigger lines. And I'm gonna switch back to the handout real quick. What you're looking for on the setup, trigger, and trade management. Setup, trigger, and trade management are expressions I got from Jake Bernstein. They work really well. The setup is what we are visually looking for and scanning for each day. We're looking for a setup. The setup of the two lines crossing. Most of our trade strategies involve either 2 lines crossing or a color change or like a hook, meaning a line goes up and down, it hooks down, or it goes down and up, creates a V and hooks up. So this is the setup we're looking for, 2 lines crossing. The confirmation is the candle has to be red. And this squeeze and Bollinger Band criteria that's not detailed here. I'll go over that during coaching sessions. But everything.
Sorry, Eversley, I just want to know where the handout is.
It's look in the chat window for the link.
Oh, I came in late, so I don't have the link.
So it's in the chat window.
No, not for me because I came in late.
I'll go to my website, go to the page with the stats and history.
Okay, cool.
And it's on there. All right. Okay, so I'm going to go back to so I'm going to go back to the chart now. Okay, should be back to the chart. So this is what I see. And I will go ahead and tell you on Australian dollar, when this happens and we have a valid trade, it is 90% winning trades, 90% winning trades. If you follow the trade management. All right. So now what do I do? I see two lines cross and a candle red, and I'm telling you it's 90% wins. What we're going to do is establish what the entry price will be, what the stop loss will be, and determine our risk for the trade. All right. So I need someone to write this down and type it into the chat window for me. We're going to put the stop loss 10 ticks above the high of these 2 days. So the high this day is 0.7538. So the stop loss is 0.7548. So someone type in 0.7548 in the chat window. That's the stop loss value. 0.754. That's 10 ticks above this high. Okay, so that's the stop loss value. The entry for the trade, if I recall correctly, is going to be 10 ticks below this low. The low this day, it's either 10 or 15, but let's go with 10 for now. 0.7422 is the low. 10 ticks below that is 0.7412. So the entry is 0.7412. Someone type that in. So now we know the stop loss and we know the entry price. Now we have to establish risk. So what I'm going to do is say for this trade, we're going to risk $1,000. Okay. So what we have to do is establish what is the risk on one lot, and then we'll be able to determine how many lots we get. So how many ticks is there? What's the difference between the stop loss and the entry price? How many ticks is that? Does someone do the, what's the difference between those two numbers? How many ticks? Number one tick is 0.0001, 2 ticks is 0.0002. So what's the difference between those two numbers, between the entry and the stop loss? That's how many ticks. Someone please type it in. $136. Okay. So 0.00136. We're looking at 4 decimal places. So with all these futures, we look at 4 decimal places. So it's 136 ticks. All right. And I'm going to go back to the website share. I'm going to go back to the Schwab site, and we're going to look at currency futures. I'm going to open that window there for currency futures. And we're going to look at the micro Aussie dollar. It's the margin is $160 to open it. And let's take a look at the contract specs for what a tick is worth. We're looking, oh yeah, currency futures. All right, M6A, Aussie currency futures. 1 tick is $1. So if our stop loss is 136 ticks and each tick is $1, what is our risk on one lot, on one contract? Someone type it in, or just tell me, what's the dollar risk? How much are we risking on one contract? Either type it in or say it.
$13.60.
Okay, it's 136 ticks and each tick is $1. Thank you, Jason. $136. See, if it's 136 ticks and each tick is $1, that's 136 times $1 times 1. So $136 is what you're risking on one contract. If you want to risk a maximum of $1,000, how many contracts can you buy? Can I define the lot? Can you please define the lot? We trade in each, one lot is one contract. That's all that is. One lot is one contract. Okay. So 7 points, you did his math. So he said 7 contracts is how many we can trade. So 1,000 times 336. That's right, 7 contracts. Jason did the math there and rounded it. So $1,000 divided by 136 is 7.35. You round that down to 7 contracts. So that is how we define risk. If we want, we always try to risk approximately the same amount of money on every trade. And if you do that, you will never have, you don't have disproportionate trades, because if you win on a trade where you risked $1,000 will not adequately offset a loss on a trade where you risked $3,000. Okay. If you risk the same, approximately the same amount on every trade, then your losses can very quickly and effectively offset your wins can effectively offset your losses really, really fast. Okay. But if you have disproportionate risk, you're guaranteed, almost guaranteed, you'll take the loss on the one where you risked more money and take the win on the one where you risked less money. And if you get a certain percentage return on a where you risked $1,000, it will be a lot less, not enough to offset the loss on a $3,000 risk or $2,000 risk. You keep it all about the same, and numbers just work out very nicely and profitably over the short and long term. Okay, so now we know we are going to get 7 contracts. I'm going to switch back to the chart. Do we have any questions so far about how we came up with that? We know our stop loss was 136 ticks. Each tick is worth $1. We're looking at this here. So that's our risk on one contract is $136. If you wanted to only risk $300, then you would get 2 contracts, because that would be 136 times 2 is 270 something. Then go over 3. So if you're only risking $300, then you would get 2 contracts. If you only wanted to risk $600, you can get 4 contracts. So that's how we can control the size of our trades and risk, by knowing what the risk is on one contract. Okay. So, and believe it or not, most people, even people who trade for a while, usually don't know how to do this basic math and calculations. They just buy, I'm going to buy 10 contracts. That's what they do. I'm going to buy 10 contracts. And then they wonder, they'll get really big wins. They'll be like, yeah, I know what I'm doing. Then they'll get wiped out all their money. They'll get really big wins. Then they get wiped out without realizing they're not managing their risk properly. They might have a good winning strategy, but if you don't have your risk managed properly, even a good winning strategy will not make you money, because you have to control the losses. Okay, see, question here. Sorry, maybe I missed this, but what about fees? How are fees paid? Fees should be not even in question. If I'm making $400, what difference would a $10 or $5 or $10 fee make? So this is not, since we're not day trading here, so fees are non-issue, because if you're risking $1,000, your first target is going to be worth $400 to $500. So in 7 times for, I know I pay about $1 for each one of these, a little over $1 for one of these contracts. If I was risking 1,000 and I got 7 contracts, it would cost me less than $10 to get into it and less than $10 to get out. So I make $400 to $500 and I spend 10 to 20 in fees. So that's what it kind of works out to. So it's not really a big deal. Yeah, so if you were day trading and going in and out with the micro contracts, then the fees start to add up. But since we are swing trading, our targets are like massive targets. We're talking really big targets. So yeah, it's only, your fees are only an issue if you're going to just scalping in like intraday trades in out a lot. Then the fees would add up, but we don't do that. That was back in the old days when we all started doing this. But as time goes on, like any other business, as you evolve, we all start out sitting in front of the computer many hours every day. We all start that way. But like any business, eventually you want to grow to not be working for every dollar you make, to be able to sit back and start letting your money work for you more than you working for it, type of thing. So it's just part of the growth of being a trader. Eventually the swing trade, you realize you can sit there for 3-4 hours a day or more, and you're going to make or lose exactly the same amount as if you're doing it for just a couple of minutes a day swing trading, except we have fewer contracts but bigger targets. And if you're doing intraday, you actually need more money because you need more contracts because you're getting smaller moves, and it takes you much longer. So there's something for everyone depending on personality, but over time and as we evolve, we didn't want to sit in front of a computer anymore doing this stuff. We know, let our money work for us while we go do other things. All right, so I'm going to go back to the chart unless we have any more questions. And then we'll get some more numbers in there so you understand how it all plays out. All right, so now 136 ticks is how big our target is. Excuse me, it's how big our stop loss is. I'm going to go with what is 40% of 136? What's 40% of 136? Type it in. How many ticks is that?
I think it's 54.4.
54. Okay. So our entry price for this is 0.75, excuse me, 0.7412. What is 54 ticks subtracted from 0.7412? So it's 0.7412 minus 0.0054. What is that value? The low entry price is 0.7412 minus 0.0054. Type it in.
0.7358.
Someone type that in. 0.7358. Okay. So that would be our first profit objective. So if our stop loss is 136 ticks, we have stats on our trading plans to show you what if you're going for 40% return, what if you're going for 45% return, what if you're going for 50% return. That's the first profit objective. We have all those numbers and stats available so you can make an educated decision which you want to do. And if you go 40%, that's literally a 40% return on your risk. So if it did nothing but get out the first target, you make a 40% return on your money. If you want more, then you trail stops, you do more work on remaining contracts. All right, so we know what our entry price is. And we have, when we place our order, this is the end of day. End of the day, this is what we see. We're not looking at any moving markets. We're not making any decisions based upon the market moving. We're making decisions based on end of day data. This is at 2 p.m. Pacific time is when this data updates, and we have our charts available for analysis. All right, so we just determined our stop loss high above this day. How we determine our entry price 10 ticks below the low of this day. We know our stop loss is 136 ticks. We know 136 is a dollar per tick. We know we're getting 7 contracts, gives us about 900 something dollar risk, somewhere there, close to 1,000, not exactly, but close to 1,000. So we have all the parameters we need now. And we know our first target is 0.7358. That's 40% of the risk of the stop loss subtracted from the entry price, right? And when we place this order, we place the entry, target, and stop loss all in one order, and then walk away, go to the gym, go out to dinner, go exercise, go do whatever you want, and live your life. Nothing else for you to do. You place your entry, target, and stop loss. The market has to go down lower for your trade order to be filled. See, it's putting in a sell stop. All right, let's take a look at this. The low the next day was 0.7413. It did not reach our entry price. This is 24 hours later. Our entry was not reached. The entry is 0.7412. The low was 0.7413. Order not filled. Olga's asking, how do you determine the stop loss? Via all the work we've done over the years, we've determined the stop loss is above a certain day at a certain amount, and that can be vary depending on the strategy. So the stop loss will be above or below, or it will be a percentage of the ATR. It depends on the strategy, and that's through many hundreds and hundreds of hours of analysis and trading to determine which stop loss we're going to use for which strategy. That basically explains it. It's just, so some of the currencies have an ATR based stop loss. Some of the currencies are the stop loss just like this one. And once you have the trading plan, you would see that. But it's based on history and what stop loss we feel would give us the results we want, which is over 80% wins. So the balancing act between how big the stop has to be and how big the target has to be. If we made the stop loss massive, huge, right, we'd get 98% wins, but at one loss we'd wipe out all the winnings, you know, so because it'd be like really big. So just a balancing act between how big the stop loss should be. So on the actual trading plans, you'll see the different values for stop losses, different combos of stop losses and targets, and with all the objective numbers there to make a choice. All right, so the next day was not filled. When we place this order, it has 2 days to be filled. If it's not filled in 2 days, you cancel the order. Within the next 48 hours, the order gets filled. Within 48 hours, the order is filled. When it gets filled, you should get an email and or text notification, the order was filled. Nothing for you to do. The order is filled, great. The next time you have to do something, maybe, is when the target gets hit. The next thing that will happen, either your stop loss will get hit and it'll be a full loss, meaning if the price goes all the way back up to here before your first target is hit, you'll be stopped out. Or the price goes down to your first target and you make money. So our first target was 0.7358. The low this day was 0.7384. So the first target was not reached. The next day, the low was 0.7360. And our first target 0.7358. The low was not reached. That means the target was not reached. So we're still in the trade. Next day, went back up, target's not hit yet. Next day, target's not hit yet. Next day, target's hit. Okay. Between all that time, there was nothing for you to do. You're trading percentages, you're trading history. And it's not that funny history where I've had people come to me with show me strategies where they analyze the last 5 years and tell me this is the greatest strategy ever. Look at this, it's a bullish strategy and it has like a 90-something% wins and this is the strategy, this is the way to go, this is what they want to trade, and I think I should trade it too. And I tell them, so you created a strategy at a time when the market was doing nothing but doubling in value. And you disregarded all the other times when the market goes up, down, sideways and everything else. And then I had them go back and start analyzing, starting with 2006 or 7, then go through all of 2007 and 8 and 9, and then stuff in between, then come back to me with the results of the strategy, and I said, never mind. So whatever strategy you trade, back test, so on and so forth, make sure that you are not fitting it to a specific time period when the market just moves in the direction you want it to. Whatever strategy because we've looked at, myself and Becky, we look at dozens of strategies, not even dozens, hundreds. And we usually start around 2000 or 2003. And we'll look at it right up to now. And you might see a 10-year stretch when it's the best strategy ever. And then on year 13, it all falls apart. On year 14, it all falls apart. And you would have lost all your money in 2 years that you made the previous 10, 12 years. Because certain market conditions exist that weren't part of your back test and analysis. So that's what makes a lot of strategies, they'll tell you, well, it stopped working. Right? Well, a certain strategy stopped working. No, your strategy never worked in the first place because you never back tested it properly enough to account for all the different market conditions that you could experience. So whatever people tell me the strategy stopped working, I first tell you, sorry, it never worked. Did you test it this far back? And usually not, because it requires massive amount of time and effort. And most people don't do that. I've had people tell me after 2008, well, that was a unique thing. It won't happen again. So we don't look at that. It was an anomaly. I'm like, no. I've literally had people tell me that. That won't happen again. So we don't really care about that. It's an anomaly in time. I'm like, no, it's not. Like, markets pull back and they can pull back for extended amounts of time at any time. But when it comes to trading and money, people put blinders on sometimes, and the logic, reason, and good judgment they use in every other part of their life goes away when it comes to trading and money. So you really got to think through what you do and make sure that whatever, if you're trading a strategy, make sure you know the history and make sure you test it back to times when it would have gone massive volatility both ways, up and down. Make sure it actually works when the market is going sideways down, that the numbers have to play out in your favor if you trade something in a dedicated way. All right, let's go back to this now. Okay, so this trade filled 2 days later, hit a target 1, 2, 3, 4, 5, 6 days after you place the order. First target's hit. If you did nothing but bought 7 contracts, excuse me, sold 7 contracts here and had the exit order to buy them back when it hit the first target for your exit, you would have had a 40% return on your money. Okay, it's a 40% return. It's easy. It's a 40% return. And just, I know some people wondering how do you do that math. Okay, once again, some more calculations. You're risking $136 per contract, and you got 7 contracts. What is 7 times 136? Anyone type it in. 7 times 136 is your risk. Get the exact numbers now. Or 7 times 136.
952.
Just type it in. Someone type it in. Okay, so your actual risk on the trade with 7 contracts is $952. Now, our first target we determined was 54 ticks. That was 40% of 136. That's $54. What is, so 54 times $1 per tick is $54. Okay, so we had 7 contracts. On each contract, we made $54. It moved 54 ticks down, hit our first target, and we sold 7 contracts. So we made $54 for each contract. What is 7 times 54? $378. And what is 952 divided by 378? Or the other way around, what's 378 divided by 952? 378 divided by 952. What's that number? Should be point something. 0.397, 39.7%. That's your 40% return at the first target. So if you do nothing but exit the whole position at the first target, you will book a 39.7% return, minus, you know, the $10 to $20 for your fees. All right. So, and remember, when you pay for futures contracts, that's a price you negotiate with your broker. They have their advertised prices, and then there's the real prices. So you can negotiate pricing with your broker depending on how much you trade, where you're coming from, previous brokers, so on and so forth. So you can always negotiate prices. So don't just go by what's printed that they put out there. Always ask for the price you want. All right. So the 40% return. And that's true on every one of our futures trades. At the first target, it's going to, well, we have at least 10 or more strategies we trade as a group that gets you in long, short at different points in the trend. And for every one of them, the minimum return is 40%, and at the first target, and I think the highest one is like 54, 55% at the first target. After the first target, you can either exit the whole position and live a simple life, no trade management, no stress, nothing to do but place your trade and walk away. It's real easy, real simple. But if you want to make more, you want to do more, you want to be more active, then what you would do is maybe sell 4 of your 7 contracts at the first target and trail the stop on the 3 remaining contracts, that type of thing. So this would be an example of where the trend kept going lower. So if you sold your first, let's say you sold for 4 contracts here when the first target got hit, and then you move your stop loss down and trail your stop, you could have a nice 80, 90, 100 something % return on this trade before you finally stopped out. Okay, depending on how you want to trail your stop. Some people don't want to deal with all of that, but it's nice to also catch some of these really big moves once in a while, because 1 or 2 of these trades where you catch the big move can offset other potential losses and really amp up your annual returns. Plus, it feels good to be in this going down. It feels really, really good. All right, this would be a good example. This is an example of the strategy, how the stops are moved, how to determine the stops, targets, the entry price, and it's a pattern that kind of repeats over and over again. It repeats over and over again. Cross down with the red candle. Cross down with the red candle. Didn't cross down with the green candle, so it's not valid. Not valid. Has to cross down with the red candle. Green candle. Cross down with the red candle. Put your order in. Fills the next day. Goes against you for a couple of days. Your stop loss is up here. Goes down. Cross down. So this is a trade that happens over and over again. And when it comes up, it's 90% winning trades when it comes up. And so this is how we trade this bearish strategy. We just spent almost an hour on this, just going over this one. So when I work with people one-on-one, we go through each strategy in detail and make sure you understand it, because it takes time. I can only give you a general concept right now. But I want to show what I really want you to understand is the money that's involved. So I'm going to go through. I asked Becky to put together a profit and loss for all the strategies we trade over the last couple of years to give you a feel for the kind of % returns you could get. So I'm going to switch over. And we can do this with, this is the one thing we can do with Forex that we can't do with options, because with options, we don't know what we're going to make until it's done, because it's variables with all the volatility issues and time decay. But with futures, it's easy. All right. So CD is Canadian dollar, Australian dollar, British pound, Russell 2000, S&P, NASDAQ, Dow, Swiss franc. Okay. So what I had Becky put together is a list of trades starting in 2019. And it's based upon a $50,000 account. And in the $50,000 account, you're risking 1% of the account per trade. Excuse me, 2% of the account per trade. So $1,000. So you're risking $1,000 on every trade. In real life, is not going to be exactly 1,000. It's going to be between 900 and 1,000, or between 1,000 and 1,100. It's going to be fluctuating because of the exact numbers. So it's not exactly 1,000, but I want you to understand based on 1,000 what to expect. All right. So we don't recommend risking more than 2% of the account per trade. Sometimes if you have a smaller account, you're going to end up risking more because it's a smaller account. You can't help it. So there's a balancing act there. But 2% account risk. If you want to go crazy, maybe 3%. If you really want to go crazy, you got to think about margin. Margin will occupy money in your account. So you don't want to run out of available capital. You always want to have enough money for the next trade, because you might be in multiple trades. Another one comes up, but all your money's tied up in margin, then you can't place a trade. So the start of January 2019, all these, Van, were you going to say something?
No, sorry.
Okay. So these are all trades for the month. So what you got, like 8 or 9 wins and 2 losses. On every loss is going to be minus $1,000 because you're risking $1,000 a trade. You just have to be consistent with it. These are all first targets only. 500. That means it's a 50% return at the first target with this particular strategy. 400. It means the 40% return on the trade with this strategy. And 42 is a 42% return on the first target with this strategy on the Russell. And there's only first target only. This does not include trailing stops for more profit. This is just if you want to do the minimum amount of work, get in, get out, nothing else. Minimum amount of work. Okay. This is comes out of $2,400, which is a 4.8% return on the account for the month. The next month, February, didn't have as many trades. $240, 0.5% return. Never, never, never focus on what's happening in one day, 1 week, or 1 month. Always think big picture. That's why I'll put this together so you understand the big picture of how we trade and how we make money. All right. Next month, March, nice month. 6% return, made $3,000. If you were risking $2,000 per trade, this would be $4,800. This would be $6,000 if you're risking $2,000 per trade. Okay. Think about that when you start thinking, well, this can start paying some real bills. Okay. Risking only $2,000 and following, just doing first target only, that's it. All right. And we do a lot of this work for you, because I place these trades, with these valid trades, into our Facebook group one afternoon, so you can actually go there and reference them. Okay, we keep going. In April, only 2 trades valid, 1.8% return, made 900. Next month, here's June, really nice month of June. If you're risking 2,000, this would be 6,800. If you're risking 4,000, if you have a bigger account, you really can control how much you risk based on the size of your account. All right. So you can see how the numbers might start adding up. All right. July, a couple of losses early on in the middle of the month. And this is what freaks people out sometimes too. They'll make a couple $100 and then they'll lose 2,000 and start losing confidence. It's like, no, just keep trading, because you got to book the wins. And next couple of months goes on, and here we are at end of the year. For the year, it comes out to making about $20,000 and a 40% return on the account, 39.9%. That's a 40% return on the account. It doesn't matter if you're trading a 20 grand account, a 50 grand account, $100,000 account, $500,000 account, our $10 million account, it's all the same. All you're doing is trading more contracts. Instead of trading a micro, you're trading the bigger size contract. Everything is exactly the same. The person making a 40% return on a $30,000 account is going to do the exact same work, spend the exact same amount of time as the person making a 40% return on a $500,000 account. Okay, it doesn't matter. This is scalable. Some strategies are not scalable. This one is scalable no matter what size account you have. You can do the exact same trade, spend the same amount of time. All right. 2020. This is when the market shut down. I mean, excuse me, the world shut down. This was literally our most profitable trading in February and March 2020. When the markets dropped that massive drop for several weeks, that is when we actually made the most money, the biggest return, 12% return for February, and 11% return, 11.5% return for March. So when we actually got the big market move down and then rallied back up is when we made the most money, because volatility is good for us. We need the market moving. Because what comes after a big market drop is massive rallies, aggressive rallies. And when we get our buy signals, you just ride those babies up. Then you get our sell signals, write them back down. So volatility works for us. So we need stuff moving the markets like we have right now. Things are moving the markets. Russia's moving the markets, and it's going to create opportunities. People who are long-term investors, it creates fear. People who are traders who know what they're doing, it creates opportunities. And it's like, this is what we live for, something that moves the markets, that will last for a little while, but it creates volatility. So we get the market will shoot down, and then we're going to get new buy signals. We're going to ride the buy signals back up, then it's going to shoot back down. It's going to create new sell signals. That's what we trade, our buy and sell signals. Okay. And we catch those moves at different points in the trend. We trade market tops, we trade market bottoms, and we have strategies that trade the in-between. All right, go over to April, another nice month, May. So let's take a look at June. Let's say you were the one who attended my meetup this week. You started learning the strategies, and then you started trading right away. And this is how your debut with me worked out. And you're gonna be like, this sucks. I spent this money hiring this guy as a trading coach, and I've done nothing but lose money. You're discouraged. You send me nasty emails, and I get those, by the way. But once this happens, my job is really more counseling, because in the back of your mind, you know the big picture, but you don't think a big picture. You always think, I'm losing all this money right now. How can I possibly place another trade? I made $400, but I lost 1,000. Then I lost another 1,000, lost another 1,000, lost another 1,000. You lose all confidence. And it happens. We had a couple of losses this past month. Big deal. Keep placing your trades. But it becomes a mental block, especially if you're new, and it's a confidence thing. That's why you really have to understand the big picture of how this works. And you will be guaranteed beyond any shadow of a doubt that you will get 3 to 5 losses in a row. It's going to happen. Absolutely will happen. But as long as you control the size of your loss, it's not a big deal. You control the size of your loss. You don't take big losses. You don't have any big losses. As long as you control this loss, limited at $1,000 on a losing trade, hits your stop loss, you're good to go, because you're going to make that back very quickly. You just keep trading. All right. So this month we had a negative month. Notice our first negative month in a year and a half, almost. The next month, hey, you're making money again. Next month, you're making money again. The next month, you're making money again. The next month came out a net loss, small loss, not a big deal. You are guaranteed you will have 2 to 3 losing months every year, beyond any shadow of a doubt. It will happen. Those 3 months will be negated by 3 winning months. That leaves the other 6 months of trading as your profit for the year. That's a big picture understanding. 3 months will be losses, negated by 3 months of wins. The other 6 months will be your profit for the year. You got to keep trading. November, very, very nice November. And now we're in December. No valid trades in December. Here are the numbers for the year. A 49% return on the account made $24,000. If you're risking $2,000 per trade, that would be $49,000. If you're risking $2,000 per trade. If you're risking $3,000 per trade, that would be $75,000. Okay, that's how the numbers work out. This is just the first target. No trailing stops. Just place your order, your entry, your target and stop loss, walk away. Okay, nothing but that. Okay, if you want to do more to make more profits, great. If all you want to do is grab your money and run, great. This 49% can easily go up to 50 something or 60 something percent return for the year if you put in the extra work and after the trail stops. But a lot of people really don't have the time to do that, desire, because they have jobs, they have families, other responsibilities, but they want to make money trading. So they'll do the minimum amount of effort needed, which is just place your entry target and stop, and then go live their lives. It'll either be a stopped out, or it'll be a first target win, one or the other. Done. All right, so now we're into 2021. And first month of the year, awesome, awesome month. Followed by another even better than awesome month. Small loss in March into April. Another net negative, but once again, small net negative. As long as you keep trading, sometimes you get discouraged because you make money for a couple of weeks, and then the last week or last 2 days of the month, you wipe out all your profits you made. It happens. Big deal. You keep trading. That's just trading. I'll answer your question in just a minute, Olga. May, great month, no losses. June, no losses. And you like those months, so the numbers add up nicely. July, September, August, perfect August, September. And we ended the year with a 55% return for the year, with all, we had a couple of losses in December, so a little bit of give back. But end of the year with a 55% return, $27,000 based on a 50. If you're risking $2,000 per trade, this would be $55,000. Okay, and once again, you don't have to deal with all the variables with options. You don't have to be up in the morning to trade. Futures trades happen after 2 p.m. Pacific time is when the markets close. They reopen at 3 p.m. Pacific time. So the best time to place your futures trades is between 3 p.m. Pacific time and maybe 5 or 6 p.m. Pacific time. That's ideal, because at that point in time, there isn't much in the markets in the world moving. The Asian markets will open up like 5, 6 p.m. and they'll start moving things around. Things will start moving, but between 3 and 6 p.m., most of the world markets are asleep. Basically, there's nothing much going on. No big announcements, because it's nighttime. Markets are closed between those times. Around 5, 6 p.m. our time Pacific is when Asian markets start opening up. Later on, the Australian markets open. So, but the best time is between 3 p.m. and 6 p.m. to place our orders. You can do it later, that's okay too. I don't always get my orders in that early. A lot of people don't. So it's not really a big deal, but the ideal time is 3 to 6 p.m. Okay, and this is for January. January is a great month again. I know we had a couple of losses in February. Becky, at the end of the month is when Becky does these updates. So she'll update the trades for this past month. I know we had a couple of losses, a couple of wins. So however that plays out. Anyway, this is what the numbers actually look like percentage wise. And you won't be in every single trade. It won't, not realistic to think you'll be in every single trade. But even if you miss a couple of wins, assume you're going to catch the losses and miss some wins. Just assume that it just sort of happens. But as long as you're very consistent with your trading, this is over 80-something% winning trades, basically. So we try to maintain at 80-something% winning trades. Our low end is 80. Some of these go as high as 90-something% wins for different strategies. Okay, the last couple of meetups where we did futures, we talked about the double D. I think it was the double D hook or the D hook. The double D hook is the one we talked about the last couple of meetups. Was this one? That was for the indices. So those were all long trades. So I wanted to do some short stuff this time because the markets have turned bearish. I want to go back to the chart real quick. Share. So we got pull up euro. We had a short last month, and Swiss franc. Let's see. Right now we have a trade on Swiss franc. So those of you in the Facebook group, this is what I posted about. If you're interested in maybe looking at placing a live trade, message me after the meetup. And this is going to be a new strategy for all of you, because unless you've done Forex with me, then you know what the strategy is. If you're doing the futures now and you haven't seen this one, message me. I'll send you the details so that you can give it some consideration if you want to place it. This one is about 81% wins in that neighborhood. So you can take a look at it and determine if it's something you want to do or not. All right. So do we have any questions? Feel free to unmute and ask any questions. I'm trying to place this one. Email me after the meeting, Jessica, and I'll send you the trading plan. Jessica is one of the coaching clients. He just messaged me asking, but email me and I'll send it to you, the trading plan for it in detail. So we do updates to the stats, the win-loss stats every 3 to 4 months. Anything you see where there are numbers in a box, Becky does that. I do not write numbers into little rectangles. I just don't do it. I write numbers into, these are my trades this past week. They're all written on this sheet of paper. That's where I write my rectangles. I don't do spreadsheets. So Becky does all the tracking of all the numbers, does all the analysis, keeps a record of all the trades that are valid. She does all of that. And so we work really well together. So I don't like doing what she does and she doesn't like doing what I do. So when we work together, I can do the presentations, I do a lot of the analysis, and then we get together and we review charts, we make sure everything, and we're always looking, how can we make more money with the strategies we have? How can we get more out of it, pull a little more juice out of every strategy? There's so many ways to make money trading, and our strategies work. Now, how do we improve on it? So we're always constantly trying to improve on it. And for the people who already trade, who already have doing the futures, this one uses the D2 buy template. I just did an update on it with some of the settings for the super trend, but it's the exact same D2 buy template, but get a new one from me with updated, and email me to get the plan. Okay. Jessica just told me she is making money on something. Good. Some Aussie futures she has going on. All right. So I'm gonna switch share again. Go back to the web streets more. Next inbox screen. Let's see. Okay. Okay, so I'm gonna change that. Just 1 second. You should read back. So on the trading plans, all of our trading plans kind of look like this. This is just bare bones. This is not a detailed trading plan. A detailed trading plan will tell you when to not trade It will tell you the settings for all the indicators. It will tell you the details for the setup detail. It will give you the details for all the trigger conditions. I mean, checklist type details, not just a general concept. And for trade management, it will give you a general trade management, but that is what you and I spend time with when I'm working with you. That's what takes the time, the trade management, to show you how to do it. So so that's where the one-on-one thing really comes in, to really understand the trade management and your different choices decisions you have to make to get the most out of it. Let's give a listing here, and the handout is some of the trades that's been valid since the end of February, the last update. Excuse me, since the end of January was the last update. So these are all the trades through the end of January. I went back the last few months, give you the win-loss status. And you can do simple math. If you risk $1,000 on a trade, every win is going to be between $400 and $500 at the first target, and every loss is going to be $1,000. Simple math. Just do the math and you get the numbers. That's all it is. It really is all it is. Olga said, what time do you put on trades? It's usually I have sometimes 6 trades on one day. Yeah, you can have multiple trades even on the futures. You're going to have multiple trades on the same symbol. And you place them all as much as you can afford financially. You place all the trades, all your trade management, and let the platform manage your positions for you. I know some people like to over spreadsheet things too much, but the platform will manage everything for you nicely. All right. So if anyone is interested in working with me on this, I usually take on maybe no more than 2 or 3 new coaching clients each month, because I do everything one-on-one. Everything I do is one-on-one. I don't do group coaching because everyone's different. They have different needs. They learn at different paces. Some people really need me to work with them on the computer part of it. Some people are new. Some people are more experienced. So everyone takes a different amount of time. So I basically will spend whatever time is needed with you. If you want to meet me one-on-one, I usually meet people in the South Bay around in Santa Clara, usually at the university. If you want to meet one-on-one, it's a great place to meet. Or we can meet on Zoom. I'm usually pretty readily available for any consultations, questions via Zoom or email. Some people like texting me, but I don't do this stuff on text unless it's a quickie question. Email me, I will get it and respond much more efficiently with email for short notice type stuff. But bottom line, we'll spend as much time as needed to get you up to speed and running. If you're brand new to futures, I will work with you to get your accounts open, get your platform set up. You're gonna need, it's not just getting NinjaTrader or the broker. There's a few things you have to do to get properly set up with your accounts and analysis and trading platforms. And you even have to answer questions a certain way for the broker to even approve your account. They've gotten a lot more strict in approving accounts. So if you tell them, yeah, I've never traded futures before, and I have a $5,000 account, and I want to open an account, it ain't happening. They're going to tell you no. So you have to answer the questions. So you have to look at what they want, find out ahead of time what they need you to do to qualify to open an account. So I can help you with that to get that all set up and working with the broker, because it might take a week or 2 to actually get an account open, because they're going to ask you questions. So you got to prep for that and be ready to go. Find the right broker that has a platform that can accommodate the type of trades we do, the order types. Not every platform can do it, most can, and then also ask about contract pricing. You don't want to be paying way too much. So just make sure you know to ask about that. But bottom line, I'll work with you for at least 6 months. I usually go longer. There are people I've been working with for years and years and years. There are people on this meetup right now that have been working with me for years. If they want to meet with me in person tomorrow, I'm not going to charge them anything. I'm going to meet with them in person tomorrow. It's just, everyone here, most of the people here are local to the Bay Area. So it's not like I go running away from people. I'm here, I talk to them on a regular basis, see them when we have in-person meetings. Again, it's one day. So I help you as much as I can. But it's $17.45 for the futures coaching. And if you're familiar with options and want to do both, it would be like $34.95 for options and futures. If you wanted to do both, I would take $250 off this price. So take $250 off $34.95. Let me know by the end of this week, and we can do the futures and options. Futures only, I will take $100 off this price. Let me know by the end of this week. So if you want to meet up right now, you know, I'll take $100 off this price for $16.45, and I'll take $250 off of this price if you want to do both futures and options. And I would say start with the futures. You're going to see more immediate results faster. And you don't have as many trades as you do with the options, but you will see results faster from the trades you do have. And it's just going to be an easier way to get into it without dealing with all of the variables options have. It's good to be able to do both. So for options, I trade oil, the metals like gas and like gold and silver, and gold mining stock and gold miners and energy sector with XLE. And for the futures, I trade the currencies, and I trade the Dow, S&P, NASDAQ, and Russell 2000. That's how I break down, separate between what I trade with options and futures. And that combination works extremely, extremely well for me. I don't get too many things expiring worthless on the option side. And when I have a loss on a futures contract, I can make the money back within 2 or 3 trades really fast. So that's the benefit of trading futures. And I don't limit how much I can make. I trail stops and I try to catch as much as I can, because you never know which the next trade will be, like the big downtrend or the big uptrend. So I try to position myself so I can capitalize on major moves, which may happen, and that can happen at any time. You will end up quite often making much more money on your second or third contracts than you did at the first target. The first target might still be 40%, but by the time you're done trailing stops, you're up to 70, 80, 90% or higher on the remaining contracts in overall position value. All right. Any questions on anything whatsoever? If you are going to set this up on your own to trade and you have questions, let me know. For the trigger lines, you can do any value you want depending on what you want to trade, but just make sure you back test it so that you get the results you want to get. If you're doing it with me, I will give you the settings for everything. I will give you the charts already set up, pre-programmed, looking the same way. Everything's done, ready for you. So just good to go right away. And so you don't have to do all that work. But do we have any questions? Feel free to unmute or type in the chat window. Our next meetup is going to be in 4 weeks on March 27th. That one's going to be featuring options. And I think I'm going to do one of the Ichimoku strategies that day. It'll either be the Ichimoku Kumo or the Ichimoku Senku strategy, or maybe both. That's one of our oldest strategies. I know Becky still trades it. I focus myself on the Donchians. I know some other people still trade them, but I know some people have heard of them but haven't seen them. But they're still around, and they have always been great strategies with bigger targets than some of the even Donchians. There aren't as many trades, but when the trades come up, it usually involves a major change in market trends. So we get bigger moves out of them. So that's going to be the Senku and Kumo setups for the Ichimoku, which many of you have not seen. Some of you have. So that's going to be coming up on March 27th. Let's see. It's 2 o'clock now. So it's our end time. But does anyone have any questions before we go? Anything you want? My whole world's open. That's anything you want. Or we can look at anything you want to look at. All righty then. Let's call it quits for the day. And Olga wants to look at the YM. Let's take a quick look at the YM. Right now, we're really waiting for a buy signal. We're waiting for this buy signal, like this starting to hook up. When we see this hook up is when we start to see markets about to turn up. So, and some of the ETFs were starting to give us getting ready for buy signals also. So we're starting to see a buy. If I were to change, we don't have the official buy yet, but that's what we're waiting for. The sell signals have already happened. We have multiple sell signals on the indices a while ago. There was the first leg down and a second leg down. There's a strategy, template load. I'm gonna change the chart template. This is one you haven't seen, Olga, but if you're familiar with the Forex strategies, you would have seen it. This is a short we had right here.
Answer
So we
your
had-
screen.
Oh yeah, okay, let me change this here. Okay. Like this, we went into cells a while ago and our next set of cells. But this is like one strategy where we have the choice of taking a short trade here. Trig extension is what we call it. And we had several trades like this. But we have all our short trades are done right now. We have no more short trades on the indices. We're just looking for long. So it was waiting patiently. And so we might get some more volatility, but I'm just waiting for our next if you take a, and if for you candlestick people, there's a morning star. Hey, okay. Stochastic's turning up. So it would not be unlikely it would not be unusual to see a nice rally back up before we slam back down again. So right now looking for short-term buys before our next sell signal. All righty. So we're going to call it an end for the day. And if you're interested in the futures coaching, please email me or call me. My information is on the handout and also on my website, behindscenes.com. And I will send it and we can chat about what your particular situation is and make sure I don't want to give you a realistic expectation of what you can do with the resources you have and what to expect. Okay, you're not going to get rich overnight, but you can generate a nice regular income, just like we went through on the spreadsheet of the trades over the last couple of years. You can generate a very, very nice regular income that can supplement what you do or what your current work, or eventually take the place off. It's been my only income for the last 2 years, and it's been really good. And trading futures is just nice, really, really nice. All right, until next month, March 27th, and then we'll go some Ichimoku options. You guys have a good day.